Bloomberg Audio Studios.
Podcasts, radio, news.
You're listening to Bloomberg UK Politics. I'm Lizzy Burden.
And I'm Stephen Carroll. Now, it is Friday. Don't be alarmed. I know we don't normally bring you a podcast, but we have a special conversation that we wanted to bring to you, our listeners, today. You know it must be important if we're bringing you a show on a Friday. We're continuing to track the market fallout from Wednesday's budget. At the time of recording, the UK's government's borrowing costs on the gilt markets are still climbing. They're now between 25 and 30 basis points higher than they were when Rachel Reeves sat down at the end of the budget.
Yeah, but look, this is nothing like the market reaction after Liz Truss's mini budget. That was about a 100 basis point move, but it is still a big deal for Labour and for Rachel Reeves. Remember, markets are the guardrails on politics. That's what we learned after the mini budget. Rachel Reeves is a woman who has staked her reputation on stability. They got into government contrasting themselves to Liz Truss. So it's not a comparison that Rachel Reeves or Labour want the papers to be making, and it is a comparison they are making. So that is why the Treasury decided yesterday that they wanted to speak directly to the markets about this. They called Bloomberg. I went to see the Chancellor and we talked at the Treasury about whether she felt she was on the cusp of her own Liz Truss moment.
The number one commitment of this government is economic and fiscal stability, which is why we put in place yesterday in the budget robust fiscal rules that we will meet 2 years early. There's a significant fiscal consolidation during the course of this Parliament that takes debt as a share of our economy from 4.5%, which is what we inherited, to 2.1% of GDP. And we've set out a framework for the second phase of the spending review based on the envelope that we set out yesterday. That will require difficult decisions, but they're ones that this government are prepared to make because we know the importance of economic and fiscal stability.
But Chancellor, your margin for error for meeting your main fiscal rules near historic lows. If there's even a minor hit to growth, you'd have to hike taxes more to hit your fiscal rule. That's not very stable for the bond vigilantes, is it?
We have more headroom than the previous government left us, and that is important to guard against those sorts of shocks. But we, in the budget yesterday, were open and honest about the scale of the challenge left to us by the previous government, but we have now put our public finances on a stable and a solid trajectory, including through difficult decisions on increasing taxes. We did increase taxes yesterday by £40 billion. That was necessary, alongside with the changes we've made on spending and welfare, to put our public finances on a firm trajectory, and that's what we did in the budget yesterday.
But how can investors believe that this is a one-off hit when you repeatedly said before the election you weren't going to raise taxes beyond your manifesto commitments? Now you've raised them £20 billion more than the fiscal hole the Tories left behind.
Well, we were left with a terrible situation by the previous government, a big black hole in the public finances, a number of commitments around infected blood and the post office scandal that weren't properly funded. We've now put all of that out in the open, and we've raised taxes in a way that now put our public finances on a stable trajectory. Indeed, the Office of Budget Responsibility confirmed that we meet both our stability and our investment rule 2 years early. That should give confidence, alongside what the International Monetary Fund said yesterday, that these were the right decisions for our public finances and indeed for growth. We're making the decisions to get our public finances on a firm trajectory and also to boost the growth potential of our economy.
But that IMF endorsement is almost out of date now, given the market reaction, and a lot of people are going to be asking what the point of all these tax rises was when the OBR sees the economy growing more slowly under this Parliament, under your plans, than if Rishi Sunak had stayed Prime Minister.
But the OBR say that their forecast in March would have been materially different if they knew then what they know now about the previous government spending plans. So those comparisons aren't fair ones to make. The OBR say that growth will be around the same in this Parliament as what they said previously. But of course, those projections were based on the spending projections, which weren't real. The growth forecasts, though, aren't the summit of my ambition, which is why we are doing planning reform, pensions reform, reform, skills reform to get our country growing again. And we're determined to do that. But the OBR also say that over the longer term, our plans will boost GDP by 1.4%. That is significant. Well, 1.4% when our economy has barely grown the last 5 years. It is a significant boost to growth. But it shows that this government, and this is 1.4% in addition to the growth we're already experiencing, just to be clear about that. And that would be a big uplift on the growth that we've experienced the last few years. But we're doing more to boost growth. We're getting Britain building again with those planning reforms. We're unlocking long-term patient capital to help small businesses and start-up and scale-up businesses to grow. All of that could have a big impact on growth, as could the £63.5 billion investment that this government unlocked at our International Investment Summit just 2 weeks ago.
And yet, Chancellor, for all your revenue raising, there is still going to be real terms cuts for some government departments. If that's not the definition of austerity, what is?
That's not correct. The numbers we put out yesterday that shows real terms increases to government spending of 1.5% during the course of this Parliament, 1.7% if you take into account capital spending as well. Austerity, 2%. Well, that would be even higher than the growth rates being forecast. Austerity is when you're cutting public spending. We're not cutting public spending, but it will require difficult decisions. And we set out the envelope for spending in the Parliament ahead at the budget yesterday. We are determined to live within our means. We are conducting a zero-based review to drive efficiency and productivity across government, because better public services are not just about money. It's about running those public services better, and that is what we're going to do.
Well, indeed, think tanks like the Resolution Foundation are saying inevitably employers are going to pass on this national insurance rise to workers, that this is going to be the worst term for living standards under any Labour government. Yes, you're not technically raising taxes on working people, but if you're honest, it's going to feel like it, won't it?
Well, the last Parliament saw living standards stagnate. It was the worst Parliament for living standards ever recorded. The Office of Budget Responsibility forecast yesterday that real household disposable income will increase on average by 0.5% in real terms per year. So that is a world away from the stagnating living standards that we saw in the last Parliament. But do we want to do more? Absolutely. That's why we're introducing planning reform, the pensions reform, the skills reform, to get Britain building, to get our economy growing again, bringing in private sector investment, for example, through the National Wealth Fund and through the International Investment Summit that unlocked £63.5 billion of private investment in the UK, showing the confidence that business and investors have in this government and our strategy.
Chancellor, you keep emphasising the long term here. Do you worry that you're not going to get 2 terms in government to realise your ambitions, to get to the summit of your ambitions, because it's going to take a decade of national renewal for people to feel better off? I'm thinking about George Bush Sr. saying, "Read my lips, no new taxes," and he was out after 1 term.
Well, we made it was a significant budget yesterday, but that budget wipes the slate clean so that we never have to do a budget like this again. We are cleaning up the mess left by the previous government, but we are meeting our fiscal rules 2 years early. We've set the spending path for public services for the course of this Parliament. We will do a zero-based review to make sure we're getting value for money for that spending. We have had to make tax increases, but that is to get our public finances on a sustainable footing. Economic and fiscal stability are the number one priorities of this government, and we will meet them.
So can I take that, a confirmation, no tax rises for the rest of this Parliament?
Well, no Chancellor is going to be able to tie their hands in that way, but there was a significant budget yesterday because we had to wipe the slate clean after the economic mismanagement, the chaos and the instability from the previous government. No government should have found themselves in the position that we did, having to clear up that mess. We've now done that, and we can move on.
So that was the Chancellor Rachel Reeves speaking exclusively to you, Lizzy, yesterday. I wonder, listening back to that conversation now, what did you take away from what Rachel Reeves told you?
Well, what I took was that there is no apology there. This is not a woman who's sorry for her budget. Clearly, the Treasury is conscious of the market impact of this budget. Clearly, they wanted to acknowledge the market moves, reassure the bond vigilantes, but they do not want to change their plans. Stability, stability, stability is the message from Rachel Reeves. And she said it there at the top and at the bottom of the interview. Stability is her number one commitment. That's what she wants the market to hear.
Well, let's talk a little bit more about what the markets did hear, both from the budget and from the interview with Rachel Reeves yesterday. Our markets reporter, Valerie Tytel, is with us. Valerie, of course, you a former bond trader, someone who knows this space very well. Can you just put in context for us the scale of the moves that we've seen on gilts? We're recording this on Friday morning and we're looking, as I say, at borrowing costs ticking higher even further today.
Yeah, a whopping, near 30 basis point rise in the gilts in the 10-year yield. And this is all down to the fact that they are borrowing more, which means they need to issue more gilts in the next fiscal year. And the number that they came out with was £297 billion worth of gilt issuance. So to put that into perspective, Stephen, before the pandemic, this number was just over 100 billion. And now we're talking a near 300 billion pounds of gilt issuance that the market has to digest, right? This is supply that's going to be issued all of next fiscal year that there's going to have to be a buyer for. And we're at a very different time in global bond markets. Global central banks have stopped doing quantitative easing. Central banks are no longer a big buyer of government debt as they were previously. And who is going to be the next marginal buyer for these extra bonds being issued in this fiscal year? That is the question that the market's raising. That is why yields have been ticking higher as they just raise an eyebrow to this eye-watering issuance number. It is the largest issuance we have seen from the UK government. If you put the COVID spending aside, it is the largest issuance we have seen from the UK government ever. And that is going to be a lot for the markets to digest because it's not on a path downwards. And you look at that in context of UK debt to GDP, it's over 100%.
I wonder, not to make it too gross, but how far into digesting this does it feel like they are? Obviously, there was a surprise in there, but the fact that we're on day 3 of market reaction on this surely tells us something.
Yeah, I mean, we've been creeping higher today. Who knows what the rest of today's session has in store for us? But this is happening, Stephen, ahead of the biggest risk event of the year for global financial markets, which is the U.S. election, with election day next Tuesday. And the risk to the gilt market is if they don't find a firm footing before that volatility, we could be in for a very volatile week next week. Not only the U.S. election, but then on Thursday, we get the Bank of England, and they're due to release their projections for growth and inflation as well. That's 2 big bombshells of a potential volatile move for the gilt market to absorb at a time where traders across London are already nervous.
So just to be absolutely clear, the US election and the Bank of England decision aren't just going to distract everybody from these problems. Oh yeah, that small issue, the Fed decision. This could actually make this worse for Rachel Reeves.
The fact that we have global governments around the world continuing to spend. I mean, look at the U.S. No matter who wins, the debt pile of the U.S. government is going to increase. And that's what most people think across the street. Look at France. They are having issues about being fiscally prudent as well, and the bond market is punishing them. They're across the globe, countries are dealing with how do we go from spending these massive packages like we did during COVID? How do we undo that in order to put us on a more financial, straightforward footing? And maybe this is the first step for Rachel Reeves to do that. But for the moment at the gilt market, you're just staring at this eye-watering number in terms of the gilt issuance next year. Because look, in the U.S., the situation is going to be the same. Most people think that the U.S. is going to have to increase their auction sizes of treasuries next year, with the treasury auctions have already been increased from a year before. So again, who is this marginal buyer of debt going to be? And for the gilt market, it is a real question because they do rely on international investors to buy their debt.
And look, it's also worth bringing it back again to how this perpetuates a budget dilemma, because higher borrowing costs, as we're seeing borrowing costs climbing for the UK, mean the bill that the UK government has to pay and will have to account for in their next budget is based on basically the interest payments and the size of the debt.
Yeah, and it goes back to this big economic framework of the fact that you need to grow more than your interest rate. Else you get caught in this cycle of your interest payments on your debt becoming
a bigger item on your budget.
Unstable, right? So the UK does need to, it needs to grow over its interest rate, which there's a big question mark if it'll be able to do that. If nominal growth and the nominal interest rate, if you get that wrong, you could be in a very, very bad debt cycle, which we have seen some few, emerging market economies go through. I'm not saying the UK is about to be there, but the debt pile globally has been climbing, and eyebrows are being raised to all this debt out there. Yeah, okay, we're not quite at doomsday scenarios yet, but certainly worth reflecting on the direction that could ultimately go in. Valerie Tytel, our markets reporter, thank you very much for joining us. That's it from us for this special podcast today. If you like the programme, don't forget to subscribe, give it 5 stars so other people can find it on Apple Podcasts, Spotify, or wherever you listen.
This episode was produced by James Wilcock, and our audio engineer was Sean Guastamakia. I'm Lizzy Burden.
And I'm Stephen Carroll. We'll be back with more on Monday. I mean it this time. I said it yesterday as well. This is Bloomberg.
Bloomberg UK Politics. Listen weekdays at noon on DAB Digital Radio in London.